Welcome to this session from the Skilled MBA Case Study Series, where we explore innovations shaping the future of venture capital. Today's case, Everglow Ventures Reinventing the VC Model, examines how Ellen Grant's venture firm is disrupting traditional venture capital by eliminating management fees and offering a startup-centric support system. How does Everglow's model compare to traditional VC? Can this zero-fee approach be sustainable long-term? How can Everglow convince skeptical investors to embrace this shift? This session explores the opportunities, risks, and strategic decisions driving Everglow's mission. Let's begin. Everglow Ventures is redefining venture capital through an innovative investment model that removes traditional constraints. Traditional VC Everglow Ventures, 2% management fees, 0 fees, more capital stays with investors. Fixed fund structure, rolling fund, flexible capital raising, limited startup support, comprehensive ecosystem, more resources for founders. By eliminating management fees and shifting to a rolling fund structure, Everglow offers a transparent, startup-friendly alternative to conventional VC firms. Everglow's disruptive model affects multiple stakeholders. Ellen Grant, founder leading strategic communications and investor relations. Limited partners, LPs. Investors evaluating the viability of this unconventional structure. Entrepreneurs. Startups benefiting from Everglow's enhanced support ecosystem. Venture capital industry. Observers tracking Everglow's potential impact on traditional VC norms. Each stakeholder group presents unique challenges and opportunities for Everglow's growth. Despite its bold vision, Everglow Ventures faces three major challenges. Communication hurdle, clearly explaining a radically different model to traditional investors. Investor skepticism, convincing LPs that a zero-fee structure is financially viable. Industry resistance, breaking through established norms in a highly traditional financial sector. Overcoming these challenges is critical to Everglow's acceptance and long-term success. Everglow Ventures has several key strengths that set it apart from traditional VC firms. Zero management fees, more capital stays in the fund, increasing potential returns. Rolling fund structure, flexible funding provides continuous access to new capital. Startup-centric support. A comprehensive ecosystem enhances portfolio company success. These strengths position Everglow as an attractive alternative for both investors and founders. However, Everglow's model also presents significant weaknesses. Untested approach. The zero-fee model lacks a proven track record. Communication challenges. Investors may struggle to understand and trust the new structure. Initial skepticism. Resistance from LPs accustomed to traditional VC structures. Resource allocation. Balancing investor education with operational demands. Addressing these weaknesses will be essential for Everglow's long-term credibility and scalability. If successfully implemented, Everglow Ventures could capitalize on several major opportunities. Market demand. Investors increasingly seek greater transparency and efficiency in venture capital. Industry leadership. Everglow could position itself as a pioneering innovator in venture funding. Startup attraction. Founders looking for hands-on support may prefer Everglow over traditional VCs. Model expansion. The rolling fund approach could scale into new investment sectors. By leveraging these opportunities, Everglow can accelerate growth and redefine venture capital investing. However, potential external threats could hinder Everglow's growth. Industry pushback. Traditional VC firms may resist change and attempt to discredit the model. Sustainability questions. Concerns over whether Everglow can maintain operations without management fees. Slow adoption. Conservative investors may be hesitant to embrace such a radical shift. Competitive imitation. established VC firms could copy elements of Everglow's model. To mitigate these threats, Everglow must demonstrate strong financial viability and market traction. Traditional venture capital firms follow a standardized investment structure that has remained largely unchanged for decades. Key features of the traditional VC model: 2% management fees. Investors, limited partners or LPs, pay 2% annually to cover fund operations, regardless of returns. 20% carry. VCs take 20% of the profits when investments succeed. Fixed fund life cycle. Most funds have a 10-year horizon, limiting flexibility. Limited startup support. Many firms provide capital but little operational assistance. While this model has been successful, it presents major inefficiencies. High fees reduce investor profits, even when performance is poor. Fixed timelines force exits, sometimes prematurely. Startups often struggle without ongoing support beyond funding. This system has worked for decades, but is it still the best approach for founders and investors? Everglow Ventures is challenging industry norms by introducing a radically different investment model that eliminates traditional constraints. How Everglow Ventures is redefining VC zero management fees, no 2% annual charge, keeping more money in the fund. Rolling fund structure, continuous fundraising, allowing greater flexibility, incentive-driven carry, performance-based profits, aligning interests with LPs. Founder-centric support provides hands-on operational guidance, not just capital. Potential benefits: higher net returns for investors. Greater capital efficiency without unnecessary fees. Stronger startup success rates with deeper VC involvement. The big question: can Everglow convince investors that this innovative model is sustainable and superior to traditional VC? To address these challenges, Everglow Ventures has 3 strategic options. 1. Market education. Launch an aggressive investor education campaign to explain the model's benefits. 2. Selective targeting. Focus on forward-thinking investors who align with Everglow's mission. 3. Strategic partnerships. Form alliances with organizations that complement the Everglow approach. A combination of these strategies will be essential for gaining investor trust and market traction. Everglow's strategic options must be evaluated against 4 key criteria. Market education, selective targeting. Strategic partnerships, investor engagement. High, educates broad LP base. Medium, reaches niche investors. High, gains credibility through alliances. Growth potential. Medium, takes time to scale. High, targets long-term relationships. High, expands reach via trusted networks. Market differentiation. High, defines Everglow's unique position. Medium, focuses on select LPs. Medium, enhances reputation through partners. Long-term sustainability. High, builds long-term investor trust. Medium, relies on LP adoption. High, reinforces Everglow's credibility. Key insight: a hybrid approach combining education, targeting, and partnerships offers the strongest path forward. Everglow's experience highlights 3 critical lessons about disrupting venture capital. 1. Clear communication is essential. Introducing new financial models requires precise, compelling messaging. 2. Market education is a key barrier. Investors need thorough explanations before adopting innovative approaches. 3. Stakeholder alignment is crucial. Long-term success depends on getting investors, founders, and partners on board. These lessons will shape Everglow's future strategy and investor relations. To ensure long-term success and adoption of its innovative VC model, Everglow Ventures should implement the following strategic recommendations. Strengthen investor communication. Clearly articulate how the zero-fee model benefits LPs, addressing skepticism with data-driven projections. Expand market education efforts. host webinars, white papers, and investor roadshows to explain the model's long-term advantages over traditional VC. Build strategic partnerships. Align with forward-thinking institutional investors and accelerators who support innovative VC structures. Demonstrate early wins, showcase successful portfolio companies, and quantify performance metrics to prove the model's viability. Gradual scaling approach. Expand cautiously, refining operations before aggressively scaling the fund. Key takeaway. By combining investor education, market proof, and strategic alignment, Everglow can gain credibility and drive adoption of its models. To execute these recommendations effectively, Everglow Ventures should follow this step-by-step action plan. 1. Refine the pitch to LPs. Develop a compelling data-backed narrative highlighting the profitability and efficiency of the zero-fee model. 2. Secure early adopters. Identify high-net-worth individuals and institutional investors open to disruptive VC strategies. 3. Launch a proof-of-concept fund. Establish a pilot fund with a small group of LPs to demonstrate real-world success. 4. Scale PR and thought leadership. Publish case studies, secure media coverage, and position Everglow as a pioneer in the VC industry. 5. Monitor and adjust. Continuously evaluate performance, gather feedback, and refine the model before broader expansion. Final thought. By executing this structured roadmap, Everglow Ventures can gain credibility, attract investors, and establish itself as a game-changer in venture capital. Thank you for joining this session of the Skilled MBA Case Study Series. We now open the floor for questions and discussion.